Hey, everybody. Welcome to the morning market briefing. It's Wednesday, April 12th, 2023. Hope you're doing well. Enjoyed seeing some of you guys out at the macro presentation last night. Shout out to Bolero, the official entertainment partner of Narwhal Capital. Chewy's stayed open late night for the boys. Big time. Steve Hislop, the best restaurateur in America, would be proud. They closed at 9. We stayed till about 9:30. And
they turned all the lights on.
Yes, it was full transparency there, but big day. We got CPI coming in. Tom, I know you're picking through the data. Ben as well. Headline expectation is 5.1%. Last reading was 6. Looking for a month over month change of 0.2. On the core side, looking for an increase of 5.6, which would be a 0.4% move month over month. What are we seeing?
So it came in broadly in line with expectations. So the headline number came in at 5% and the expectation was 5.1, but that's a big move down from 6% last month. The core did come in right in line with expectation at 5.6, which is a slight acceleration from the previous month. And then month over month headline, we actually came in at 0.1 versus 0.2. So that's down from 0.4. And then the core came in line, of course, because it matched as well on the overall number at 0.4. Down from 0.5. So I would say overall, this is pretty positive, I'd say. I know Ben's going to dig into the data. We're still waiting on the revisions from last month to see if there's any changes there. But I mean, we came in under on the headline number. We came in right in line with expectations on the core number. I think this is again, pretty sticky, but I think we're showing some signs that we're starting to move. And of course, this is backward looking. I think we get next month, we're going to get a surprise to the downside would be my expectation. Because this, again, doesn't take into account everything that's happened. This is just March data.
Yeah, I mean, pretty good numbers, I would say.
Yeah.
In terms of not necessarily being a surprise, but also moving in the correct direction.
Yeah, bond market is appreciating this at the moment. We're seeing green across the board. So I think that's a pretty good indicator that it's being read as a positive number, at least in the short term here.
Yeah, interesting. Ben, what's standing out to you?
Yeah, I mean, we're now cycling over the period of very high gas prices and energy prices from last year. So that had an impact on the year-over-year number. But even on the month-over-month data, you had energy that was down 3.5% on a month-over-month seasonally adjusted basis. So that's really influencing things down. That's probably going to reverse back next month with the recent higher oil prices. But excluding food and energy, you did have a little bit of a come down in apparel. That was 0.8 for the last 2 months on a month over month basis. Now that's down to 0.3. And then you also came down a little bit on shelter. You went from 0.8 to 0.6. So that's really driving the core down a little bit. Transportation did tick up. It's still 1.4% month over month seasonally adjusted. I'm trying to figure out why that transportation number is elevated. I'm guessing it is due, and it's primarily due to airline fares accelerating again. And it has just been a constant theme. You also saw significant tick up in motor vehicle insurance, up 1.2% month over month seasonally adjusted. So there are a few areas here where you're starting to see some pickup in inflation. But at the end of the day, I think that with the shelter component coming down, I think that's probably good news and will speak to Tom's point last night when we talked about inflation coming down and why we think that the core might continue to come down is because that inflation component in housing is beginning to come down.
Yeah, that owner's equivalent rent, which has never seemed all that accurate, but now seems to at least be moving in the right direction.
Yeah,
right.
It's like it doesn't matter if the measure is correct or not, as long as it's trending in the right direction.
Yeah.
Also, we got in the real average hourly and weekly earnings, which both showed significant declines. So real average hourly earnings year over year was down 0.7% for the month, and weekly earnings was down 1.6% for the month. So
on the but the hourly number, that down 0.7 is probably a little better than we've seen in some time. I remember that was down about 3.4% in last summer.
Yeah, it was down 1.3 last month, but it's still
down. Still down, but not
Closing
as down.
Closing the gap there. And some interesting activity on the mortgage side as well, Ben.
Yeah, it's picking up a little bit. It's extremely volatile data, but we did see mortgage application surprise a bit to the upside last week. It was up 5.3%. It was down 4.1% the prior week. So net, about even. But it's interesting that we saw some mortgage applications pick up even on the week of Easter. So curious and I'm interested in that. But I do think that overall we're seeing a normalization in very many markets. We're seeing a bit of a normalization in the housing market, and I think we're definitely seeing big time normalization in how much people are spending at retail.
Yeah, we'll kind of circle back to that point probably here in a little bit. Tom, what are we hearing from the Fed?
So we got a lot of Fed talking heads out yesterday. The big one that was really hitting right as we were leaving for the macro was Goolsbee, who came out and said, given how uncertainty abounds and where these financial headwinds are going, I think we need to be cautious. Going on to say we should gather further data and be careful about raising rates too aggressively until we see how much work the headwinds are doing for us in getting down inflation. So basically, you had him come out, you had Harker also come out with some comments, and both of them were basically starting to ring the bell that potentially they shouldn't raise rates additionally, that the financial stresses of the bank failures are starting to create their own demand headwind that is separate but not mutually exclusive from the rate hikes. Parker said available data to determine what, if any, additional actions we need to take. He said those remarks. He was at the Wharton School of Business. However, we also did hear from John Williams, who's the vice chairman, who was slightly more hawkish. They basically said they were watching credit and bank conditions very closely, but there weren't signs yet that business or consumer spending were strongly influenced by changing lending standards. Well, I would say that that's going to take
because he hasn't been looking at the data.
Yeah,
I mean, it's like, if you look at the official data, we don't have official data from there, so you can't say that.
Yeah,
and even today, there's a headline about CarMax saying stricter lending standards have impacted their business.
And this is the vice chairman of the Fed.
Yeah,
it's unbelievable to me.
They just look at the wrong stuff. They look at everything that's either 2 months old or 6 months old, and they think somehow that relates to what's happening right now. And it is alarming that they were so far, inflation was transitory. They didn't need to, do all the quantitative tightening. Inflation got out of control and became not transitory. And now they're like, well, inflation is definitely not going away. We need to double down on this. And it's potential that we could start to see things really crumble very quickly.
It's like you look at someone's blood pressure from 3 months ago, who you diagnosed and treated, and they were 150 over 100, slightly high blood pressure. Today, they might be 130 over 100. They're trending down, and it's lower. But you're angry the last time it was 150 over 100.
Double the meds.
Yeah.
It's pretty wild. I mean,
it's kind of like, I don't know if anybody ever watched Westworld. I only really watched the first season, but there's the robots who live in a weird cowboy world. And if they saw anything that didn't jibe with the weird metaverse they lived in, they just say, well, it doesn't look like anything to me. So if somebody had a cell phone around or something, they just couldn't see it.
Blocked it.
Yeah. So that's what it reminds me of. It's just like, hey man, the economy's really slowing, banks are failing. It's like, doesn't look like anything to me.
I don't see it.
Yeah.
We do have a 10-year auction today, a 30-year auction tomorrow. Tom, what are you expecting?
I think we'll probably have a pretty strong 10-year today. The only caveat is that we're seeing such a big move already that maybe the number won't be as exciting because we've already seen the move. We started at a 350 and everyone got excited because this CPI and they got down to 335. That would be a great auction. But if the bonds already moved down, you're probably not going to get much of a push through the initial offer price after that move. So I think it's going to be probably pretty good. Though I mean, probably not an A+ because we're already seeing demand there.
And the other piece is you're going to get the minutes an hour after the auction. So these insurance companies and pension funds are going to have to put the bids in before they get the minutes from the meeting. So you might just want to wait and punt until tomorrow when you have the 30-year.
I do worry that the minutes are not going to match up with reality because, again, they're a month old and they're going to be probably far more hawkish than reality should dictate. And that may cause a little bit of a swing later in the afternoon on bonds. But I think there's enough people who understand that that's the case, that it hopefully shouldn't cause too much volatility. But, you never know. People react so quickly and so aggressively to news these days. It's sort of hard to predict. But for the moment, even if we do get that, we at the worst case scenario, we'll probably end up still ahead of where we started the day.
Meanwhile, in equity news, Emerson is buying National Instruments for $60 a share. Equity value just north of $8 billion. Ben, what's the angle here?
Yeah, Emerson is about a $60 billion company. They've continued to buy and sell companies throughout their history and then just prune and replant their portfolio. The problem is they don't really do it to a great deal of success. They kind of buy these businesses and then try to cobble them together. The goal, National Instruments put itself up for sale on January 13th. Since that time, it's about 50% up to this, up to the deal price. So this is a 14% premium to yesterday's close. So a relatively modest premium to that, but National Instruments had already put itself up for sale. So it was pricing in a little bit of a premium. It's a good business. They provide test and measurement solutions for the semiconductor electronic market, electric vehicle space, aerospace defense. And Emerson does factory automation. They really want to lean into that type of business. They think that it'll grow 4 to 7% on through the cycle basis, which is a good growth rate, but it's not fantastic. I mean, it's kind of GDP plus.
Yeah.
Which for factory automation, you'd like to be a little bit higher. They want to get $165 million of synergies by year 5. So that is a very low synergy number for an $8 billion acquisition. And you're waiting 5 years for that to happen. So I think this is probably par for the course for Emerson, a relatively weak acquisition. They're marrying it with this sale of the climate solutions business to Blackstone. So they're going to fund the deal with that. It's just a company that you look at Emerson and you think, well, that should be a normal stock based on how we invest and the types of companies that we tend to like, the companies with a long track record, but they unfortunately have a track record of just muddling along and never really outperforming.
Yeah.
I was out on Emerson Electric when they sold InSinkErator to Whirlpool.
Yeah.
I mean, what the best products in the world are the ones that everyone has, but nobody knows they have, and that's InSinkErator, which is your garbage disposal.
Yeah, good luck buying a garbage disposal that's not an InSinkErator.
Yeah,
I mean,
so that's when I was out.
Meanwhile, we did get comments from Warren Buffett. He says that he expects there will be continued failures with banks. There's going to continue to be problems there. He cautions that troubled banks are not value stocks. He does think Bank of America is doing a good job. Gave Moynihan some praise there. Thinks Norfolk Southern really botched the train derailment story. And I don't know that anyone would necessarily disagree with that. Big J Powell fan says he's been terrific. Any takeaways from Buffett's commentary?
I do love the quote that Ben included here in the notes, that troubled banks are not value stocks. And I think that's something to remember, because
they look cheap.
Yeah, they look cheap. Listen, a ton of these banks got absolutely whacked, but just because they're going down doesn't mean there's not a reason for that. The thing about a stock that goes from 10 to 3 is it can go from 3 to 0. And 3 to $1.50 is just as bad. So it's one of those things where, it seems very tempting to jump in on a lot of these banks, but you're chasing your tail, I think, in a lot of these situations.
And I think, Warren Buffett kind of a lot of this stuff is common sense, but he's saying, I feel like anyone could have written exactly what he just said. Norfolk Southern didn't handle things well, et cetera, et cetera. But because it's Warren Buffett, I think it carries a little bit more weight. He does dance around some issues. So, for example, he is continuing to hold Bank of America because he, according to him, really likes Brian Moynihan. He also has massive gains in it, and although he says he wants to pay more taxes, he doesn't want to pay more taxes, so he's not going to sell the stock.
Yeah. Jay Powell's been terrific because guess what? He's also one of the largest owners of American Express. And what happens when interest rates go up? All those people who are now spending all of those savings are putting them on credit cards at higher interest rates. And that money goes in Warren Buffett's pocket.
He also won't comment on whether or not he's had recent talks with the Biden administration. I'm sure he has.
Oh, yeah.
And he also says that, and I agree with this, that depositors will almost certainly be safe in a lot of these banks, but stockholders won't be.
Yep.
And he said, you just don't want to step into that because you can get wiped out overnight. And we talked about that yesterday. When you're investing in a bank, the bank has a very clear incentive and almost a fiduciary duty in a way not to tell you the truth. Because as soon as they tell you the truth about, hey, we're in trouble, everyone's gone and the bank ceases to exist. So it's kind of this perverse situation that you end up having.
The truth will set you free of your investment value.
I do think the commercial real estate space is a place that you have to watch. When we did a big run on regional banks, we really tried to avoid the commercial real estate sector. C&I loans, I think you're probably okay. Consumer loans is a little bit dicey, but commercial real estate, a lot of banks, that was the easy money. Lending for construction loans, lending for multifamily developments, for office buildings. It should be easy money. It was. It's not so easy anymore.
Last thing, Bank of America notes that after starting the year on a strong footing, Bank of America's aggregated credit and debit card spending per household moderated in March to 0.1% increase year over year. It's the slowest pace of growth since February 2021.
Yeah, if you want this chart, I mean, it's pretty remarkable. It goes back to March 22, and it shows retail spending excluding restaurants going back to index to January 2020. And we've basically swan dived over the last 6 months from 100 to 96. So basically 4% below the spending, not adjusted for inflation since versus 2020. So people are spending a lot less at retail in the nominal terms, let alone real terms. And I think that that's going to set up for pretty big negative guidance revisions from retailers and consumer discretionary stocks over the next few weeks.
Yeah, definitely something to keep an eye on. We'll wrap it up there. We will be back tomorrow at 8:30. Hope you guys have a great day. We'll talk to you soon.